Welcome back. It is Jobs Friday. Today we are awaiting the December jobs report. The latest expectations show 164,000 jobs added to the economy in the month of December. The unemployment rate sticking to its 50-year low of 3.5%. Joining us right now is Mahoney Asset Management CEO Ken Mahoney. And Kenny, it's good to see you this morning.
Good to see you. Happy Friday.
What's priced into the market right now? Is it about 160,000? Do you think if we have a number much different than that, markets move on this?
I don't know. You know, the last couple of times I've been fortunate to be here on set, and I took the over. Okay, so I'm going to take the over. I'm not going to jinx myself. I'm going to take the over 164,000 again because this is a job creation economy machine going on right now. If you look at business services, you look at healthcare. I mean, just the number of jobs that are created is unbelievable. So
yeah, but look at this market. What's priced? I mean, we hit more record highs yesterday. We're in uncharted territory. Dow Industrial's about to hit 29,000. I
think all it has to do with the Fed. Think about a year ago, right? The balance sheet was contracting about $60 billion a month, and here we are a year later, expanding their balance sheet by about $100 billion per month. The last 4 months, $400 billion. It's a lot of liquidity sloshing around. So I think that's what's driving the markets right now. It's kind of a stealth QE, so to speak, right?
I like
You know, that's one of the things. You know, when you look at 2019, the market benefited enormously from this unexpected drop by interest rates, short-term rates, corporate bond yields, whatever. And this year, I don't think you're going to see a repeat of that decline by interest rates. If anything, there's a possibility they may be edging higher towards year's end. So we're leaning heavily on a recovery by profits growth. Where is that recovery going to come from?
I don't know. I think it's also just, you know, kind of catching up with performance. I mean, it's kind of being fear left out of this market is one of the things that happens. So, you know, you look at human behavior, it's not emotional, you know, it's emotional. It doesn't always set the logic to say, hey, you know what, here's our ratios, here's our future PEs, and here are the numbers. When it starts going like this and you get behind the 8 ball, money's got to slosh into the market to keep up with the Joneses.
But I think it's imperative, you know, looking ahead to 2020, that you avoid a material decline by profits. If you get that, you're going to be in a lot of trouble, especially since the market's so richly valued. The higher your PE ratio, the more downside risk you have in case you run into some bad news.
Right, and I think it's really interesting, the jobs report that we have here today. You know, it used to be this kind of tug of war, push and pull with the Fed. Like, we're rooting for a good number now, but a few months ago, we're not rooting for good numbers in the unemployment report because what? Here comes Fed Chair Powell with a bucket of cold water to throw on top of the markets, right? So here we have this kind of thing that we can actually root for a good number, job creation number above 164,000, hopefully.
And the Fed has indicated that it's willing to tolerate a slightly faster rate of price inflation in order to compensate for the low inflation of the past. On the other hand, the bond market may not think the same way the Fed does. The bond market may become frightened if they see the Fed becoming more tolerant of faster price growth, and you could see a steepening of the yield curve. The 10-year
that would definitely take money out of the market. Right. So 10-year, 180, 190. So if that were to lift and cause more competition to stocks, you're right. I mean, if we start having a 10-year 2.5%, 3%, yeah, money is going to start sloshing back into bonds out of stocks. So that's probably the biggest risk this year is higher interest rates, especially that 10-year to watch.
14 months ago, the 10-year yield was at almost 3.25%. So there's not any money. Money would continue even this year to flood into fixed income. If anything, people are probably under-allocated to stocks and over-allocated to treasuries, which look like that they have price risk in if you're buying at 1.85% on the 10-year.
So you had noted that there were a lot of job gains in the healthcare sector last year. So what do you think of some of this conversation that we're having about healthcare coming from both sides, actually, but mainly coming from the left? How do you think that that could affect the amount of jobs that we have in that sector?
We're going to need 1 million new nurses coming up. I mean,
look at the demographics. Someone turns 64 every 10 seconds, basically. You know, and you're right. So the demographics are shifting. We really need healthcare. And the problem you're finding from employers is they can't get enough employees. So why this is a great job market, the pendulum swung almost too much the other way and saying, hey, we need more people. We need more people to hire.
So they just don't have enough qualified people.
Right at this point, yeah.
Interesting.
Yeah.
And you're going to have to keep people in the workforce longer. I mean, de facto, the retirement age might become something like 72 years looking into the future if you're going to have a shortage of younger workers. I think over the next 10 years, Americans aged 65 and older growing by 1.8 million per year. On the other hand, Americans aged 20 to 64 will be growing by roughly 400,000 people per year.
Who's going to take care of us?
Bottom line.
You have to take care of yourself.
Your money to work in this morning. You want to buy stocks here, or you want to hold on?
Look, we like little pullbacks here. We are definitely extended, but again, we're not really overbought. At least the oscillators that we use. My go-to all of last year being on set was XLK. Now, granted, that's Apple-centric, that's Microsoft-centric, but it's worked very well. Again, we still like technology, still like growth. We do believe the money keeps going to higher beta names as long as the Fed stays away.
All right.
And I think one thing to consider is that the rest of the world has lagged behind the United States. Maybe we'll get lucky in 2020, and the rest of the world's going to wake up. And these companies you were speaking about that have a lot of global exposure will exceed expectations.
That'd be nice. We'd like to see some profit growth and not have the heavy lifting done by multiple expansions like we saw last year. I'd like to see some earnings growth as well to support these prices.
Look, the fourth quarter earnings season kicks off next week.
Yeah, it's great.
So,
right to the banks. And yeah, exactly. Go right into it.
The banks reporting the fourth quarter next week. John, later I want to get your expectations in terms of profit growth for the fourth quarter and all of 2020, by the way. Ken, it's good to see you.
Okay, great to see you.
Thank you so much. Ken Mahoney joining us.